second day. Now is your time, press play. Play. Maybe we imagined it. Could this be fantasy? Play. 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 Free falling. Free falling with you. Free falling with you. Free falling with you.
What's up, guys? How's everybody doing? Good afternoon, good evening, good night, depending on where you are. Get started in a second. Just give me a quick sound check, and then we'll be off to the races. We're gonna start this stream like Michael Saylor starts every single one of his answers on interviews. You guys saw that video I shared yesterday? They asked Saylor anything about Bitcoin. He goes before he answers. Guy seems a little bit on edge. Cool. Muted? No. I'm not muted. Sound is great. Cool. We'll get started in a second. I'll say hi to everybody. Just as a reminder, if you're not a subscriber, go ahead and subscribe to the YouTube channel. Please hit the like button. Yes, now we are making a concerted effort. We're putting in a concerted effort towards being more active on YouTube, and these streams will be every Tuesday and Thursday at 1 p.m. So it'll be consistent. So make sure you subscribe, make sure you put us on alerts, and we have something new that's coming and it's still being worked on. I promised you guys that since the beginning of the year, but nothing good comes overnight, right? So we're almost there. So make sure you have us on alerts so that you can be the first to find out. Cornholio, what's up? Samurai, Pouncing Penguin, Mr. Brainiac, Chris with a beard. Better than Chris without a beard, right? Patrick Kells, Mark, Boov, Asgard, Mr. Smith, Immortality. That's bold. EM3, what's up, buddy? Bahamas, what's up? Mr. Smith, Skeleton, Black Vines, Hussein, what's up? Al Ghul, I apologize if I massacred pronouncing that that name. Danique, Woof, Ellie. Cool. All right, guys. So yeah, we have a lot to talk about. I won't waste much time. As always, all the formalities to get those out of the way first. Everything that I talk about, everything I say, it is what, right? Not financial advice, strictly for entertainment purposes only. Try to keep it as entertaining as possible. Sometimes I'm boring, sometimes I'm on top of my stuff, sometimes I have headaches and brain fog. I think today we're good. Posted recently that I'm starting to tackle personal fitness again. I shared a picture, and it's quite funny because I shared that picture and I got a lot of responses from, I guess, people that are a little bit older like myself. I'm in my 30s. I won't say what part of my 30s. You guys can guess. And some responses were, yeah, the good old days, it's tough to get back to that. And I'm thinking, guys, this picture was like from 2 years ago. So it's not like I've, completely changed. I'm not like the diametric opposite of that image. But I put on a little bit of a hide. I guess we'll call it a hide. It's a bear market, so bears have hides. But I am full steam ahead to get back to where I was in that picture. And I've always prioritized lifting and fitness my entire life. I mean, from the time I was I think 7 years old, my uncle had me lifting weights. I was a 3-4 season athlete my entire life. Got into boxing and Muay Thai after college, and now I golf, right? And I'm a great golfer, but I want to get back to that peak physical fitness. So I shared that. I got some funny responses. It's always a compliment when people think that you're on gear or steroids, and I'm all natural. On God, on my family, all natural. I've taken creatine before, the whey protein. I've always had a very healthy, clean diet. I think that I've deviated from that recently. All right. Cool. So, I'm going to touch on some things in the beginning. Not a whole lot has changed. Again, some of the stuff that I go through, if you guys see any platforms, all the exchanges I talk about, links are below. So you'll see that Phemex link is down there, Phemex.trade, that's working again. Some of the order flow platforms, anything that you guys are curious about that whether it's a platform that I get data from or what I trade off of. If you don't see it below, always feel free to send me a DM. They're on and off sometimes, but I've tried to get back to them more recently. So anyway, with that being said, let's get started. Okay, so not a whole lot has changed. I'm not going to change the screen yet, but not a whole lot has changed. Obviously, in the last quarter, we've been within a very large range. We've been in a non-accommodative sort of Fed environment, not sort of, definitely, for the last, 15 years, going on 15 years. It's been a very one-way environment. Don't fade the Fed. The Fed has been, the Fed put has always been there. We're not quite there yet. We're like 13% off the highs. The expectations are that if the S&P was down 20%, that is like the final piece of bear market criteria, by the way, that we haven't yet satisfied, that 20% off the highs. But the Fed has always been accommodative, right? It's always been there to backstop us. And now we're dealing with an environment where that lever is not pulled. So the expectations are for things to just continue to be this way, in my opinion, for the year, unless there's any kind of massive change, right? So I don't think we're looking at a situation where, for example, if the Fed comes out tomorrow and is, not absurdly hawkish, and I'll get into my expectations and my plan of attack. I don't think that means the markets are just going to go resume what they've done for the last few years. I think that we're blessed at times with some short-term momentum and potentially some, short to mid-term trends. But I think that there's always been something that comes up, always have another event to look forward to, another piece of data or metric to come out and, for us to get back to this point that we were out of only for a month, where it's, we're looking to the next meeting now. I wonder what they're going to do at the next meeting. So obviously the market has priced in a significant amount of hikes, but markets are still in a very touchy, sensitive place. So I would just expect that, just don't fade the trend, right? Go with the trend. Well, the trend you're always thinking of is a trend that's moving up or a trend that's moving down. And the trend right now is just a pattern of market behavior. So they're choppy. They're, for the most part, trendless. And just expect this to persist until there is some kind of massive change. And when there is a massive change, there will be people. It's not that, you'll think that is, for example, Zoltan came out and he thinks that the Fed is going to resume QE in 2023. If the Fed resumes QE in 2023, that is as clear of a signal as you can get, right? If there's more of an injection of liquidity into the system, that we're in a long only environment for however long that lasts. Okay, if you have if you have record inflation, there's only so many places you could put money, and there's going to be a lot of people chasing risk assets again if we do have, that kind of accommodative Fed environment. That'll be something that people fade the way that they're fading the Fed right now and still trying to look for the reason to be overly bullish beyond mid-time frames. All right, so first things to touch on, right? Not a whole lot has changed. My whole focus is going to be on tomorrow. It's just going to be on getting some good trades tomorrow, seeing exactly what the Fed says, obviously, because I think that'll have implications moving forward that will have, a bit of a wake to them, or rather have follow through. But there's some things to touch on right away. So, for example, I shared an image either yesterday or the day before. It was of the top of the book liquidity for the S&P. So, best bid, best offer. We've heard of this a lot of times. If you're looking at a depth chart for BTC, if you're looking at like Trading Light, if you're looking at Okotoki or anything that shows a book, right? Best bid, best offer. It's been thinner in the last couple months than it has been ever in the last 5 years. And you could scale this based on, the depth, obviously, but best bid, best offer, that's top of book. If you go like 2% depth, 5% depth, 10% depth, it's still the same story. The market has thinned out pretty significantly. So this has narrowed out tremendously. So far, the S&P is 13% off the highs. I think it's 13%, just kind of riffing on that. 20% has been the level that the market expects that the Fed would start being accommodative or, stepping in. Again, I've referred to the S&P as more or less the happiness index, for a lot of reasons. Thin markets imply that there's not a whole lot that stands in the way of big moves. So tomorrow is going to be a FOMC, CPI, non-farm payroll. These three events are what you would consider, as me coming from originally trading equities and then trading equity derivatives. And when I say equity derivatives, I don't mean, some kind of high-level maths options trader. I mean index futures. These are the most significant days of the year to be active. So you have a thinner market, and you have a day that you're going to expect a tremendous amount of volatility, period. It's only going to exacerbate that volatility. What we do see is that, the VIX is elevated, right? BTC has never really bottomed on an elevated VIX. But that could change very quickly. But the VIX is pretty much elevated into the end of the year. So if you look at like futures term structure, if you look at VIX futures into the end of the year, it was over 30 until recently, right? Across the board, all expiries, all tenors. I think it's now, we're looking out into like December, January of next year, it's like 27 or 28. So still elevated. So the market is fearful, right? So VIX being, at the money index options, implied volatility. So the market is fearful, right? Downside protection has been favored. So the potential is that, the market is positioned one way. So something that's overtly dovish could catch a significant portion of the market offsides. Puts being sold, options dealers, options writers are pretty much never wrong. But it's the buyers who take sort of directional trades, right? They're the delta, they're not delta neutral, closer to delta one. Delta one would be futures, but not delta neutral for options, right? So obviously some measure of delta, some measure of long gamma, long delta, and a directional outlook on the market. Puts obviously implying that the market is going to be, puts implying that they're buying insurance or betting on further downside. So the market is positioned that way. There's a good chance that some of the hedges unwound, some of those futures that are sold to hedge those by dealers could unwind and provide some kind of tailwinds if we have, if we have any kind of surprise. The market is caught on its heels to something that's maybe overly dovish, or right the one thing that would be very hawkish. I'm sorry if I'm kind of going through the macro a little too much. The one thing that would catch the market offsides would be if QT was faster or larger, because that is sort of the elephant in the room. It's not just rate hikes, right? Because the market, the Fed has more or less jawboned rates, jawbones rates to the point where the hikes didn't necessarily matter. But obviously hikes they make it real because it's, that's not just the market pricing it in, it's the Fed actually making that decision. But the market has priced in a significant amount of that. But what the market isn't as effective as at pricing in is one, uncertainty always, and two, the unwind of the balance sheet and tightening overall. Okay, so let's change the screen real quick. Take a look at a chart. I got to pull it up because I had a lot of things in my way. When I go on like one of those monologues, I feel like if I have aggro up, if I have too many things up, it's way too distracting. 1 second. Sorry, moving Streamlabs. Let's make sure that I can still see this though. Okay, and transition. Good. All right, excellent. So my plan of attack, and I write down my plan, so I'm just going to tell you exactly the notes that I have. So crypto playbook for FOMC tomorrow. So today, tomorrow, 2-day event. Tomorrow at 2 p.m. That's the actual announcement of what will be the rate decision. Okay. So here is what happened during the last meetings. All right. So my plan to begin with is to join at the first move. Right. And if you guys see me looking up, I am reading right off of what I wrote. Every time that there's a CPI, there's FOMC. Every time there is something that's a major market catalyst that has, it creates ripples in the short term. I always have a plan down, and I'm always very methodical with how I set myself up for that day going into the event. I honestly, since I am a manual trader, that means point and click. I do have, obviously I can set up hotkeys too. I always kind of rehearse my actions because if you don't have a plan, if you don't do this frequently enough, the simple entry and exit of a trade during this kind of highly volatile period, you're going to be acting under duress, right? You're going to be acting under stressful conditions. It's very easy to make a mistake. I've made countless mistakes in my trading career. So I think it's writing it down makes it real. You have sort of a schematic that you're following and then rehearsing it. And I clean my workstation up and I only want to focus on the lower time frame chart. I have my ladder, I have my tape, I have my footprint chart. That's it. I know my levels by heart at that point already. So I want to try to join at the first move. And again, guys, I'm going to touch on the high time frame and stuff, but I really only care about the FOMC. The market has been shit lately, not interesting. It's waiting for the FOMC. There's no point in me talking about all-time highs right now. There's no point in me talking about, fucking 28K. So it's important to focus on what has been, our window of activity for a quarter, right? And it's compressing even more. So I want to try to enter the first move, right? So entering the first move means getting the jump on the actual announcement. So this is where it's important to have a fast data source. I don't mean, your free Twitter. I mean something that you have an edge in terms of latency by either paying for some kind of advanced data feed or, having access to somebody. The first trade is going to be an exit at a predetermined level. So it's going to be a bracket order. What that means is I place the entry, the exit's placed right away. Maybe the trade runs, a lot of times my entry is I'm clicking right away, going with the direction of the trade. And I'm talking about there's really no equivocation. Post announcement, you're going to see the candle start getting away from you. I'm trying to enter in on that with not small size, but nothing very significant because everyone else is responding to algo activities in crypto markets. Algo activity in crypto markets is slower compared to HFT and legacy, but it's become a lot more efficient, when you're sweeping the book, meaning market buying, because you're not getting filled if you don't. Everyone else is doing it too. So you're kind of buying into, there's no supply, right? So not a meaningful position in this, not to say I haven't had meaningful results, but getting into a trade at the first response by the market, getting out at a predetermined level. A lot of times for me, this has been, you could use ATR, but for me, what I found is I know the market is usually going to move at least 100 to 150 basis points. So I'm out of the position a lot of times by the time it even gets to 150 basis points. So what has happened in the past is crypto has rallied like, 300 basis points, 2 to 3%. That's what that means. And then it's completely reversed. Okay, so I'm trying to get in the trade right away as fast as possible, get the jump on the response, and I'm getting out no matter what. And what that means is I watch the market go in the direction that I was in, and it usually travels, well beyond my target. And this is just something you have to live with, because if I try to cut more out of that, it's very easy for the trade to just fall flat and you to get out at break even, because you swept the book on the way up. And then if you're trying to get out at the turn, everyone else is too. And it becomes sort of like, it's that image of a crowded room with a very narrow door. So I know that I should just get out at 100 to 150 basis points and be grateful for that. The next trade is one where I'm trying to be I'm taking a little bit more nuance, paying attention to order flow, and trying to really capture the turn, because this is where you have a very significant unwind. So a lot of times, every time it's been a complete reversal, right? Every time in recent history, which is relevant history because macro conditions are more recent. So historical shit is not really important right now. It's what has happened in the last couple months. So this is a complete reversal. So a lot of times what you'll see is the move at the jump. So let's say Bitcoin pops up. This is something that'll last maybe 10 minutes, right? And 10 to 15 minutes, if I could recall correctly. And then a lot of times it's engulfed almost completely in a half an hour, and it's well beyond that, right? So complete unwind, right? So market positions to some advance, right? So there's an initial pop-up, right? So if the market starts to move up, I'm getting out at either 100 to 150 basis points. I'll pay attention to it, but a lot of times it's nothing beyond that. But the first move is usually wrong, right? And a lot of times, anyone who's been somewhat savvy for trading this market and trading legacy knows that a lot of the times that the first 30 minutes are irrelevant, and the first move is usually wrong. And because of that, after you have an extension, out of the gate, there's no bid on the way back. It's not like the market yanks up 3% and people think that this is the breakout to get behind, so when it pulls back, let's buy the dip. The book really just kind of evaporates. So on the way back, there's no bid pressure. And because of this, leading into this, usually you'll have some degree of risk built up. So you'll see open interest maybe slightly increase, people sort of pre-position. Yeah, some will be rewarded a little bit more than others. But then after the move, you have chasers. And because you have chasers, you have a market that's very heavy in one direction. You have risk positioned before, you have risk positioned after. And because of that, you have a very big overthrow. So if you have a pump that's 2 to 3%, right, 200 to 300 basis points, what you're looking at almost all the time, every time, is a reversal that'll engulf the entire structure and some of the structure that preceded it, and is usually a multiple of 1.5 to 2 that. So 3% pop, you're looking at a 6% drawdown from that high. So it's actually I focus on really trying to capture the turn. So on January 26th, no hike really expected. S&P leading up to the meeting rose 3%, popped 100 basis points, right? So 100 basis points, 1%. Reversed the entire day in 30 minutes. BTC leading up to that led 6%. Returned 300 basis points post. So pop, reversed the entire structure in a half hour. Okay, and then March 16th, hike expected. So just providing a little bit of context, you have a hike that's expected. S&P leads up to the meeting around 5%. Post announcement dropped 1.5%. Reversed that entire move in less than 3 hours. So there was actually a drop. And the market reversed that entire move and returned quite significantly in the day that followed. Bitcoin up to the move, right? So up to the announcement, almost an immediate 2% drop right after. And in less than 5 minutes, full extent of the moves covered. And again, both of the markets completely reversed course. There was, meat to capture right after the announcement and a lot more meat on the bone after. So again, the first trade is always very crowded, and that's why it unwinds the most. So I think that kind of covers that. I just wanted to go over a playbook. I think it's always important to have a playbook. The expectations right now are obviously a hike. The market is priced in that to I would say a significant extent, unless there is either, like I said, more significant QT in terms of amount and acceleration or pace. I honestly think, gun to head, what do you think is going to happen? I think the first move is going to be a drop, and then I think we're going to have a pop. So I think that, again, and this is contingent rather on us not having any kind of change, or rather surprise, in terms of the pace and extent of QT, or intensity rather. I guess that's the better way to put it. So without that, right, market is priced in a fair amount. Risk is positioned to the downside leading up to this across legacy markets. We're a high degree of correlation. So if legacy drops, pops, I don't see why Bitcoin wouldn't follow. All right, guys. Sorry, that has been extensive, but let me just go through this and then we'll look at the charts. Good. Thanks, Ailey. Yes, last 2 days. Tomorrow is the great decision. Okay. I haven't gotten for a PR in a long time in squat, bench, deadlift, or any of that. It's not my intention really anymore to have personal bests in terms of weight. I also don't really care about bench press. I never really did. I like strict press, overhead press. You're not really going to find yourself in a lot of places in life where this motion is really necessary. I think the sort of primal motions of lifting and pushing up are a little bit more necessary. So biceps also kind of fluff too, right? I mean, what is a bicep good for? Turning a doorknob, right? Unless you're doing something that's a little bit more isometric in the real world. Okay, so briefly, just to touch in, do you have any strategies going in tomorrow? Did you just sign in? Because I just went over the entire thing, but I'll go over it on the chart, make it a little bit easier. Paul Tudor Jones today saying that he doesn't want to own stocks or bonds. Didn't start saying that he, let me get this off. Didn't say anything about his position on crypto other than he thinks there's a lot of young talent going into the space. Something like that, right? Which is kind of like, I don't know, that doesn't sound too good, right? It's not him saying, it sounds like he's more or less, indicating that he doesn't, that he thinks crypto is along the same lines of stocks in terms of what he wants to own. But he says something kind, right? It's sort of like a shit sandwich, or backhanded compliment in that way. I mean, it came across to me like complimenting a child at a science fair as like a person who works at like the Mayo Clinic. Like, oh, what you're doing over here is nice though, but right now things are a little bit more, we have to worry about adult matters. All right, so high time frame chart. I don't want to focus on this really because I think that it's become a little redundant recently. I've gone over it a bunch of times in the last stream. Also, we have 17 bidding that's going to be summarizing this stream. So after it, you'll be able to read the important points. I had a contest where everyone got to submit their summary with respect to previous streams as more or less of an application. So if you guys miss the stream, if you find it easier to read certain things, he does a phenomenal job, and he'll be summarizing the streams moving forward. And I believe he'll be posting them on a Medium page. So it'll be great for you guys. So quarter, right? This is you're looking at right now. You're looking at quarterly value basically. So that's quarterly VWAP. It's the yearly VWAP, right? I mean, we're into the second quarter, but we're in the month of May, right? First quarter is the bulk of where the activity has taken place, or dictated rather, the range that we're within. So we're looking at quarterly VWAP, yearly VWAP. So I'll just say yearly because that's the correct term. But again, this is first quarter right here, and the range has been the significant structure that we've been ping-ponging within. Favoring the lows more recently, no real major springy effect right now. This kind of grinding behavior is not something that I think often, is something that allows you to just kind of step into the trend moving up if it's been grinding down. But like I said, a spike down followed by a reversal, that would be something I can anticipate, I could see happening. Higher time frame levels, again, just marked off, and they coincide with these VWAP bands, so one standard deviation band. So that's your value area high, value area low. That's right around 38.12, 37.6, 44.5 region for the value area high. The way I look at this, we have that inside month setup. It hasn't taken place yet. So inside month finally closed out the prior month. There was a wick at the low, right? So I said that this would be the first time we didn't have a wick at the low of a monthly candle that closed down. There's like a $10 wick, something that's infinitesimally small, almost negligible, but still, right? Technically speaking, there's a wick. When I say wick, shadow, low of this candle is basically, the close of this is basically the low. But we have an inside month setup still. So the prior month, which is right below, what is this? 37.6, and the high. Inside day, inside month, inside week, that is a break from balance setup, and that is without seeing that there is a very balanced distribution leading into it. You could have a monthly setup that transitioned, up and down, leaving a trend within, and still gives you that inside month setup. But it wouldn't be as powerful, as potent, because it's not necessarily balanced inside. This structure as a whole is very balanced. Right? I'll show you from a profile standpoint. So you have a very balanced structure. So you have a break from balance setup, period, and you have this inside structure, so this inside monthly structure that gives you a pretty good signal to act around. And what I think is, if we accept below, not last month's, but the month of March, if we accept below those lows, so it's basically, it's the lows of where we've favored for, this entire region. If we accept below those lows, it's probably a breakout that you don't want to fade, right? So the first leg is the one that you would have, I guess, the highest expectancy in terms of outcomes. And acceptance means there's no, immediate response. We don't see any kind of immediate trap. The market is not remaining bid. There's a lot of different ways you could characterize it. But a break outside of that monthly low, from a technical standpoint, a lot of the times you're just looking at the next monthly low. So your target would be like 37.5 region down to, this is 34.3. I think that because we have not just an inside month, but a very balanced setup right here. And again, what I'll do is now I'll make it a little bit more obvious. I'll put monthly profiles on this chart. So 1 month. Okay, let's take price off. Now you'll see, so here is your value area of this month or last month, value area of March, value area of February, and value area of January. So this entire structure, value was inside of January. For the most part, March was inside of February, inside of January. April, same story. The point of control has been pretty isolated. So the point of control is actually right around where we are now. So this means that this is the area where the most amount of volume was transacted. So you could assume that there's a significant amount of risk that was placed around this region. Now, again, this has been, a quarter now plus. So there's probably been a significant amount of turnover. It's not like we've seen a one-way trip in open interest from the beginning of the structure, where we'd say like, there's a ton of longs that are built up in this structure. But this has been a very significant region that we've been favoring. There has been no migration upward, meaning value has not moved outside of this structure. So the point is, it's a TA setup from a price action standpoint on the monthly, and it's like the prototypical setup from a TPO standpoint for a break from balance. So when you break outside of this composite, right, again, so here and here, if we break below these lows, I don't think we're just going to go to, the lows of February. I think it's more likely, and maybe, and again, I didn't want to talk on the high time frame too much because it's all kind of old now. We've been within a range, so that implies that nothing has really changed. But the point is, a change after that, so anything that is a change after that, so for example, fair value has been in this window between 30, what is it, the window between 44 and 37, well, if suddenly we're being accepted outside of that, that's an indication of change, and it's the first change after a long time of no change. And this was a range that was tight, right? But there was no inside structure really. We had migration lower overall. So the market was trying to push in one direction. This is a whole lot of activity isolated to one region. So if you're above it or below it, there's one side that is clearly wrong. And we know how this market treats very significant breakouts, especially after you've already attempted to move through the high. You put in an attempt at the low. If we were to break that monthly setup or trigger that setup, I think that you're looking at least down, at the lowest monthly close within this entire structure. So looking at this entire structure, and that's around 31. Honestly, if we broke lower from here, I expect more than that though. I would say that the best place to capture the market or to catch the market most on its heels, or as I like to just say, make everyone say, oh fuck, is probably the lows, right? So what that means to me is, let's say tomorrow is the catalyst. If it's bearish, I'm not just saying that this level is irrelevant. I honestly think that level, if we came to it, I think that would be awesome actually, because it would mean that the market has a lot of zip to it. It would suddenly make trading for the next couple of weeks very exciting. But I think if we come down here, that is the best place to create a trap, right? Because it looks horrible. So you're looking in that region for the signs that, Delta is very there's a lot of conviction towards the lows, open interest builds up, you see signs in basis and funding, sentiment across the board. You want to see that really build and be one-sided. It might be the time to shave my beard or my nose hairs, can't tell. You want to see that the market is very one-sided in that region if we get there, and ultimately holds that region, right? So strength in price action, reclaiming levels, right? Trading up on futures basis, trading negative. So all these things would be, I think, a good sign that I would want to see to get long at an area where it's the best it is the best level in this chart from a contextual risk reward standpoint to long. Now, why is that? It's because, one, if you look at this entire structure, it's a range. And again, my drawings are loose. It's a range, and we're not at the extreme. So when you're at the extreme, again, this is an area where everybody in the market is concerned about. So the most participation would come into this level. Whereas in the middle of a range, your swing traders, your scalpers, but your investors, your position traders, they might not necessarily care. Ton of liquidity down here though. Same way as there's a ton of liquidity locally below 37. So from a contextual risk reward standpoint, it doesn't get better than down here, because if you fall into this region, there's not a whole lot that stands in the way. So you're fucking wrong if you're long down here and the market is not holding, continuing to break down and head towards 20. Like, it's a no-brainer. I mean, you don't want to hold from 28 to 20, but I think you get the idea, right? There's plenty of chances to get in and out of trades, but if it doesn't work down there, you want to get the fuck out, right? You want to see it show signs of crowding and all the signs you would want to look for at one extreme of the market. Extremes in sentiment, extremes in positioning. So let's go to the low time frames, because this is going to be what is most significant for tomorrow. So choppy market. So we're just looking at, I have a profile set up right now. Hopefully the contrast is good enough for you guys. No maintaining of value, right? So market is establishing value in one area, chopping around, migrating lower, accepting into prior days. There's no balance that's forming on the lower time frames. In the last couple of days, you could create a composite if it was off of just ranges alone, but it's a choppy market, and it makes sense because we're not in a good place for anyone to position. It's really dumb to get into position right now because it's a gamble, more or less. What you can say is that if the Fed comes out dovish tomorrow, and you don't have to interpret this, there's smarter people than yourself that are on Twitter that know how to read into this stuff. I suggest you find them. I'll try to post what I think immediately after. If the Fed comes out dovish, all right, the market yanks down initially, rips up, or let's say it doesn't even follow that because it doesn't have to. Let's say 6 hours after the event, the market looks strong, the S&P is gaining ground to the upside. I would probably be looking for a dip, right? Pretty simple. But positioning in advance of this just seems like a pretty dumb idea. It's not like we have, if anything right now, what we've seen leading up in the last couple of weeks has been the market looks like it's going to trend in one direction. Market gets very heavy, sort of crowds the other side, one side of the boat, and then you create a very big imbalance, right? So the market is smarter, larger players, market makers, whatever you want to, attribute this to, poaching behavior, right? Like hunting. Poaching is a little bit more of a negative connotation, right, than just hunting. But, market is crowding to one area. There's really no significant change in open interest until we have a big move and then break a level either to the high or to the low. Open interest, the velocity of open interest is really obvious. It rips up. It becomes very clear that there's a lot of positioning that suddenly has gotten involved. And all the market has to do is start trading against that. And I say the market, but it's a lot of the times in a PvP environment, so player versus player, it's cannibalistic, right? There are larger players that know that there's edge to pushing the market against these pain points because the squeeze, whether it's to the upside or to the downside, will lead it'll lead to a significant amount of follow through. So we had that a couple times. So more significantly, we had that right here. So you had the market that was the market. I say it sounds so ridiculous. The market. What do you mean? You had the market that. Here I am arguing with how I'm talking. But we have a strong move up. Claim the top side of a previous range. Looks like it's going to continue positioning in advance of that. If we look at CVD on futures, the spot CVD is completely limp. Future CVD still aggressive, getting absorbed. In that unwind, you think, okay, so the market reclaimed structure to the upside. It should, retest. This is a reclaim of level. It should lead to continuation. So the breakdown should be what? It should be very bearish at that point, right? If you have a reclaim and then it gets completely engulfed, it's probably going far in the opposite direction. Nope, right? So the breakdown gets crowded. So you have open interest increasing sharply, CVD's down, selling occurring, expecting this to continue. And then after that stays dormant for a while, it's just a slow push, squeezing those entities out. So from here to here, you have the increase, and then it's a slow push back to basically break even. And if you looked at a TPO for this structure, so hold on one sec, I'll show you. If you look at this TPO, now I closed my long too early down here before this ledge. But once we accepted back within this gap, right, no shorts were challenged on the way down. No shorts were challenged. There's no clear invalidation. It just becomes, it's a void, right? It's a vacuum. All it takes is for the price to briefly accept back within here, and then you just have this sort of domino effect of shorts closing out because they're not, they're poorly defined and they chased all the way down and there was no interference with them whatsoever. Right, so a lot of times when you have a double distribution like this, so one-sided move down or move up, more often than not, they're long liquidation structures and panic selling on the way down that leave the most ugly double distributions, whereas moves up tend to be a little bit more grindy. The double distributions upward, if they do occur, they're definitely not moves to get. I don't think they're moves that are necessarily signs of strength. Same way to the downside, right? It's a very one-sided move, but if you accept back within that gap, 9 times out of 10, you're going to traverse the entire range of that gap. So we did. We closed above the ledge and covered the entire gap, and I closed my long way too early, and I was asleep by the time that the move actually started to accept. You win some, you lose some. A lot of times you're out of most of them. So real quick, right now, positioning into the event, it kind of looks like, we have funding that's been neutral to positive. Spot was selling in the last day and a half. Nothing tremendous, but I think as you would expect from people that are risking off into a very significant event. But now you have futures that have been buying, funding positive, no major liquidations at all in the last, in month to date. I think that'll change soon, but you could see more recently if we're just looking at what has occurred in this very tight range, if you see what open interest has done, we've gone up from 121,000 BTC all the way up to 128,000. These are not on all exchanges, but it's on Binance, it's on FTX, and that includes Bybit as well. So if you consider just 8,000 BTC, and if you just gave that an average price of it's 38,000. 38. We'll say 38,000. You're looking at $300 million of risk added. We'll convert it to USD, so you'll see. So you're looking at from 4.68 to right around 4.9, so just under that. So that's a significant amount of risk added overall in anticipation. For every long, right, on futures, there's someone on the other side of that. Majority of the time, it's going to be a market maker, right? But the idea would be more simply, aside from outside of, let's just look at this locally. Outside of that is from, we'll just look at the low, May 2nd, 1320. So right down, right here. So from here to here, you have $300 million worth of risk added, right? 300 million contracts worth of risk. So you could assume that if you just looked at this as a range on its own, if we're here, if we're above 39. So if we're below 37.8, if we're above 39, if it's one-sided, someone's going to be very offside, but it looks like in anticipation of this event, there's probably a little bit more futures aggressive longs than, I would say, okay, so there's aggressive longs, but that implies there's a passive seller. I don't think that it's a passive seller that is opening to short right here. Could be, but I think that if anyone is going to get ran off sides initially, it would be longs, and that's kind of like why I think it's possible to see sort of a dump first before any continued movement upward if it's not as bad as we expect. If things are bad, let's say the Fed comes out, and again, I'm operating, so say 1 minute from now, we're looking at, say 1 minute from now, it's the FOMC decision. So where is my tool? So we could just band it manually because I have a tool, but it's probably stuck back some portion on the last meeting, honestly. Here's 100 basis points to the upside. Here's 100 basis points to the downside. If the move first is down, most of the time it's what I said, it carries through beyond 2, but it's something like this, right, that completely engulfs much further in the opposite direction. I'm not really playing outside of this range to start. If things are really bad tomorrow, let's say that the pace, the intensity of QT is unexpectedly negative, unexpectedly hawkish, and they still drill the language about inflation being horrible and that being their primary interest, and okay, the economy being good, right? Now we saw that GDP was negative 1.4%. That's not good. But if they try to be creative with some kind of, maybe it's transitory, still, if they do what Biden did in the speaking after, where he said it was due to a certain factors, well, it's like fucking clearly it's a formula. That if you took one factor out, it's irreducibly complex based on that formula, right? You only have the whole with the parts. So if it's very negative, and just to touch back on the, here's one way to think of it. So this open interest increase, so from here, if we break down let's say again, the languages or the details with the pace of QT and the intensity of QT, I've said intensity now so many times, I got to figure out a different word, is really negative and unexpected. If we break down outside of that 1% range and we don't see any kind of change in open interest, and we don't see any kind of liquidations yet, I would anticipate the move going a lot further. Right? If you don't see an unwind from that initial move, it's outside of that. What did I say? Oh, it's actually, no, it's right here. Sorry. It just happens to be that it's right here. If the market migrates higher, it'd be a different story. Here's where the open interest increases come from now. So it's right here. So honestly, if we have a breakdown tomorrow, if the case is that these are longs that are going to get wiped, you would want to see that this honestly gets wiped right away. So it does something like that. If we start to get away and this doesn't change at all, then yeah, this was shorts that were positioned early and were right, which is interesting because, again, just to touch more on sort of a game plan and expectations moving forward, let's say that, and this is probably the most useful because this is kind of what I've been saying I anticipate. Let me clear this up. I have it saved, so I'm just going to make it a little bit more so that it stands out a little bit better. Let's say that nothing unexpected comes tomorrow. We get our move to the downside of, let's say, 200 basis points. Okay, after that move, there's no real change, no real material change in open interest. Okay, so anyone who got in position and this risk that was newly added clearly is either outside of harm's way if they're long, or it's not longs, right? Or not aggressive longs, right? If that occurs, if you get this initial move and there's no real wipe, that just has me think that the follow-through move in the opposite direction or the reversal is much more likely to have legs. If you get back up to this point, let's say the market breaks down, stalls, you have some kind of 5-minute engulfing candle, crowding if you're looking at a footprint, market stalls and starts trading back above that, or again, if you're looking at a candle, maybe it's a 5-minute engulfing candle of structure that it established to the downside on the way down. This could be 5 minutes, could be 15 minutes, could be a half hour. If you have that, and we start moving up back towards this high and open interest hasn't changed, that's probably a pretty good signal to get aggressive on the long side. Because the chances are that if this entire structure were looked at, you could say that going back to these highs, there's still a good amount of stops to be ran from overly aggressive shorts that haven't been squeezed out yet. So the point is, I guess what I should clearly say is, the point is you could be all the way back up here before you cause any kind of major squeeze. Now you can see where it sharply increased, but it began from down here. So your follow through, it should be very significant. If, like I said, the first move is down, no change in open interest, no liquidations, and then we start creeping back to the upside, you're going to get those liquidations. It's going to be from one side of the market or the other. Does this all make sense? I'm just going to go through the chat real quick. So just for my friend who is summarizing this, I think I should be a little bit more clear and cogent maybe. If we break down as the first move and there's no major liquidations, then the pain trade is obviously not yet done, and the move to the upside is where you're going to get the liquidations. And it's not like, my idea is that you're going to have liquidations tomorrow. One side of the market's going to get screwed. Probably both sides, okay? But one side is going to have a lot more follow through. And I guess the sign for me to get more aggressive, because I said I'm tying this back to my original point at the beginning of the stream. I want to really take advantage of the second move, right? The first move, I want to get in and out very mechanically, no major commitment in terms of risk. But the second move is where I really want to try to exploit one side of the market as much as possible, because you've seen in the past that the reversal, whether it's the reversal and it occurs to the upside or to the downside, has very significant follow through. My bearish setup is TP TPO chart, footprint, a tape, a tick chart. I mean, it's not, I can't reduce it too much because then you're just trading up price action. This is pretty flat leading into the meeting from 24 hours out, to be honest, because the last meetings we've seen a little bit more of directional certainty by the market. So, I mean, I don't know. I don't want to say too much about what that means after, because it's FOMC. It's like, don't make too many, have a sort of a rule book going into it, but I'm not going to jump to too many assumptions because that's just increasing levels of complexity that I think are unnecessary. The first move is always the most crowded, though. The first move will reverse due to crowding into traps. The latter leg that the last time lasted for over half a day, it'll just, if anything, if I'm going to be looking to end it based on a loss of momentum. So it'll probably just taper off. But I want to be in the second trade for as long as possible, which is kind of tautological, but, it's not tautological. It's a no-brainer. That red car. What red car? That's not a car. That's Mike Tyson's boxing glove with his signature on it. Is there any other car? I don't have a car in here, and I don't have a red car. Sorry, guys, just going through all this. Listen, options are a great play leading into this. You could buy some, if premium's cheap. It seems like a good amount of people are playing for the pop as well with 40K strikes. No. First of all, Pentoshi's position is probably 20 million. From what I gathered, if he buys 400 to 500 BTC, he's playing with 20 million position, a $20 million position. Seems to be, the size that he uses. He's a little public with that, which makes me think that it is his size, meaning he doesn't have 100 million. So, and 300 million is significant. It's something that will absolutely lead to follow through if you're a short-term trader. Like the 300 million will be washed out in less than a day. So it's not like you're looking at this and saying that this increase in open interest is going to lead to a move over the course of a week. It's not. It's actually insignificant. But the point is, for a move right after FOMC, if it remains elevated, then until it's depleted. It will be depleted at some point, right? Someone is going to get screwed tomorrow. If we don't have at least $20 million worth of liquidations in a couple minutes, I would be surprised. Car on the screen, top left. Oh, that's weird. And I think it's an old feature of Coinalyze. It says, quote, in Tesla Model 3, one car equals $37,990. No, my portfolio is structured. I have like I said many times before, I passively index in equities. My main concentration is in crypto and cash. So for all intents and purposes, it's like a barbell between risk and no risk. And it isn't bonds, right? It's pretty self-explanatory when you say barbell to most people, but for me, it's cash, stables, crypto. And I have spot exposure that's, I have cold spot exposure that's multi-sigged, but I'm pretty flat across what I have on exchanges. Pretty flat. All right, are we doing so any questions, guys? Because I don't think it's worth going into alts. To be fair, we're highly correlated with equity index futures right now, whether you're talking about the ES, the NQ. So we're beta to that. We're at least a 2, beta of 2 to the index. And then you have ETH that's higher beta than us. And then alts are much higher beta, much less liquidity right now. I don't see any kind of idiosyncratic flows between alts besides recently with APE and GMT. I think these things are running their course a lot faster. That's where we are in the cycle. So I'm not like, for example, I'm not looking to buy the dip in alts along with if the follow through move tomorrow with BTC is up. I'm not like immediately. I'm not lined up with alts that I want to also be long. That's just, I'd rather take advantage of the move. Honestly, I've been trading less recently anyway. I'm not trying to have a bunch of line items in an environment that has kind of petered out no matter what. So again, until the high time frame levels change, tomorrow's move could be a brief move that rewards us maybe for a couple days, but the most significant change comes outside of these levels. No brainer. Right, so we're within a range, just going to trade it like a range. There's obviously better risk reward at certain points within the range. If we break to the lows, if we break through this low and we accept below this low, I think we'll have maybe a month of great trading. But tomorrow's meeting, let's say it leads to a pop after, let's say a breakdown and leads to a pop. I think that maybe gives us 24 hours of a decent lower time frame trend. But I'm not trying to increase my line items. When I say line items, I mean add alts during that period. Because chances are, if it doesn't take us outside of this range, whatever occurs tomorrow, if we're still within this range, I just expect the chop to continue. And maybe the market just gets way more boring, and who knows. But alts, they just don't seem compelling. If we look at the S&P right now, this is a nice looking weekly in the making, right? We're halfway through the week. So if there's some kind of pulling off of the gas, if there's anything that's interpreted as even remotely dovish, like I said, we're in a position where, it all depends. There's so many different outcomes that you could arrive to. If it's neutral tomorrow, then we have possibly a good short-term play in the day to follow. If it's slightly positive, slightly dovish, then yeah, we're looking at some more upside, maybe the highs of the range for BTC, relief for the S&P. It's going to follow the S&P either way. Anything even remotely negative or more negative and unexpected, it's probably going to lead to bloodbath. But that's all this stuff is kind of. It's a given at this point, right? We've been seeing the same market now. FXS, yeah. It's still stuck within a range too. I get bullish on alts. I've had a couple swings in the last couple months, but I've been out of everything again. I don't have enough belief in alts in this kind of environment. I'm willing to believe in anything when it's a bull market, but too many people are just way too trusting of tailwinds that will eventually come. And I've seen the market just continue to put in new lows for so long, being through multiple cycles, that I don't care. I'll buy higher again. I'd rather buy when it looks like terrible at the lows again, or buy much higher when it's breaking outside of the range. So not really interested in FXS right now. Yeah, I think that if anything on the high time frame, like I said to start the stream, I think that the market has been, from an option standpoint, from a future standpoint, I think that the market has been more bearish than anything else. Recession, more rate hikes, every kind of headline you can imagine. There's been no positive headlines. The war, inflation, gas prices, commodities getting torched, you name it. So I think that the pain trade, honestly, I hate the term the pain trade. I think the pain trade is up because you have people that are, one, just, I think there's more, the market is more bearish than anything else. I think you have very low positioning by traditional players like hedge funds, money managers, not long only massive managers that are buying based on mandate, but just people across the risk curve, right? That are just like, fuck this. I'd rather wait this out. So I think the market is sidelined to a large extent, but that's like, the feelings are not really valid. It's kind of anecdotal, right? This is my opinion based on kind of the same kind of stuff you guys have access to. What I will say is that I was trying to think of something while I was talking and I was losing my train of thought, kind of trailed off. The pain trade to the upside is painful because at this point, a lot of people have lost their money and they're going to be watching themselves. They're going to be watching price get back to, or the pain trade is watching price get back to a point where you would have been break even, or you would have been back to your high water mark in your portfolio. So I think that's more painful than anything. But getting into that conversation, like about pain trades and sentiment, it becomes a little bit more woo-woo because I'd rather just look at options and actual order flow to get a feel for how the market is positioned or where the market is placing fear. And then right now, I think you can say the market is placing fear to the downside from an options and future standpoint. But more recently, again, talking from zoomed out for this entire structure to zoomed in. More recently, in the last couple of hours, it looks like there's a little bit more champing on the bit by longs. So wash out, that's why I think beginning wash out, and then we got to move up. Barring no change and no major hawkish development. But that's like saying, at this point, it's like saying, if it rains tomorrow, it's going to be wet. If it doesn't, it's not going to be. High State Capital is the man. I think High State Capital is he's a great trader. I don't think he's for everybody. I think in terms of whales in this market and legends, I think High Stakes Capital is the one who would have the chapter dedicated to like balls to the wall risk taking, and I respect that. I don't think necessarily everybody should follow in his footsteps, though I will say his hit rate is incredible. So maybe don't follow in his footsteps in terms of positioning, risk, the amount of risk you're taking, but from a directional standpoint, he's been pretty spot on. So I think I pretty much covered everything I wanted to touch on in terms of plans, my outlook. And I'm not interested in alts right now. So I kind of touched on this recently. Bitcoin kind of reminds me of it looks like it's doing what it did back here, back in July 2021. Now, from a positioning standpoint, it's a little different. Open interest had been a lot higher overall for this entire range going on back here. From a funding standpoint, if we just look at this in the high time frame, It's not quite the same. It's much more one-sided last year. Much more one-sided. So, just from looking at basis, looking at predictive funding, looking at funding. If you looked at funding, this is predictive funding. Whereas here it's a lot more back and forth. It's been neutral. It's been slightly negative. It's a different context though. Down here, equities led. So 2000. I keep looking at the other screen to make sure I'm in focus. June, July 2021, equities took the lead. So you had a strong stock market at that point, or a strong trend. Completely different context right now, right? So you can't really compare these two and glean too much from that. Yeah, the NFT market is not liquid. It's very detached. So yeah, it is. It's on a different island. So, I don't know. If you guys don't have any other questions, I feel like I touched on everything I wanted to touch on. High time frame hasn't changed. The big change is closer than it has been, right, with us favoring the lows, but my sole interest really is just getting some good trades on tomorrow. I personally, even though I think that we get something where we initially break down and then have a reversal upward, I personally would like to see the market. I mean, it could be a move to the upside that gets sort of the same, that involves the same follow through. But I because we're closer to the bottom, if the market took out the lows, I would be thrilled. I know it might hurt some people, but I think that if you accept outside of a range, and again, it's a very balanced structure, so there would be a high probability of continuation at that point, right? Don't fade the first leg. I just think the change in market structure would bring about a lot of activity. Whereas if we just stay within a range, it's like, we're still stuck within the same range. Trade the range until something changes. But if there's nothing else, I think I'm going to wrap it up. No, I don't think 2008 and 2000 and right now are similar. So I think the large spot sellers are probably TradFi funds that are I think TradFi funds based in the United States are probably de-risking leading to the FOMC. They tend to put on positions and then puke them very quickly. Once position goes past their break-even point, they tend to de-risk. So fast money, hedge funds. All right, guys, I'm going to wrap it up. Thanks for tuning in. Be sure to check out Phemex. The link is down below at Phemex.trade. If you're not subscribed, make sure you subscribe. And after this, there will be a summary that will be available to you guys so that if you miss the stream, if you miss some points, they will probably be summarized better than I could communicate, hopefully, if I was to write them. What do I think about GCR? He's awesome. He's a legend. There's a lot of people in this market that I really enjoy. There's a lot, and I say there's a lot, but there's actually a few. I enjoy a lot of people, but I really respect a few people. So, all right, guys. And I actually, I don't know high stakes, but GCR I'm a little bit more familiar with. One thing that I really respect GCR for, and it has nothing to do with trading, and it's I've seen him be charitable, so I think that is quite telling. Seems like a good person. All right, guys. Until then, until next time, until Thursday. Have fun tomorrow. Stay safe. Have a plan. All right, that's all I can say. Write down.